Hello, everybody. This is Chris Latham with Latham Wealth Management. I'd like to welcome you all to the 2023 halftime report. We're going to go through today and try to unpack a lot of the things, big events that have been happening with the economy and the markets, and try to explain them in layman's terms so they're a little more easily understood. So, got a lot of stuff to go through, and we'll just jump right into it. I'm going to speak kind of quickly because we don't have a heck of a lot of time, and we've got a lot to go through. So this little guy here, he did not follow the Latham Wealth 5-step money management process, and he now regrets it. So, you can always get back on track. It's not a problem. So the risk, obviously, there's no chance of being able to predict the future. When you're investing money, there's risks involved. But certainly the more information you have, the better off you're going to be. So today we're going to talk about the economy, the financial markets, what has been going on, why, and what may lay ahead. So the economy, you got a picture of a jumbo jet, and that's pretty appropriate. You know, the economy has really been bouncing up and down, kind of like a jet in some rough air, basically. This chart that you see is GDP, gross domestic product. It's all the goods and services that are produced each quarter in the U.S. And when you hear the economy is growing, this is how they measure it. So the dark blue lines that you see there, that's gross domestic product. The light blue lines, those are real GDP numbers. That's GDP after inflation. So basically, we want to know, is the economy growing? Okay, that's GDP, but is it growing on its own? And, are companies selling more products and making more money, or are companies making more money because they're charging more, higher prices? That's inflation. We don't want that scenario because that's not sustainable. So you can see here in March of 2023 or 2022, the Fed began to raise interest rates. And after over a year of telling everybody, don't worry about it, inflation is transitory, it's going to go away, it wasn't going away. And they finally realized in that quarter, first quarter actually, there was a negative real GDP print. So after inflation, the economy was contracting. So what do you do when there's a high level of inflation? The Fed raises interest rates to try to tamp down that inflation. Get it back to reasonable levels. Now, it's interesting because you can see here on this chart, interest rates were at zero. And this is after the pandemic coming out for the last couple of years. They held rates at zero, the Fed did. This is the Fed funds rate. It's the overnight lending rate that banks charge each other. The Fed, they control the short-term rates, Fed funds. They don't control long-term rates. So that's a very steep incline there from 0 to 5.25% just here a week and a half ago. What you'll notice, though, you don't see it going back far enough, but the Fed funds rate was held down at zero ever since the end of 2008. We had a couple of years here in 2017, 2018, where they tried to raise rates, and it wasn't working real well, to the point where right in the beginning of 2019, a lot of people don't remember, but the Fed had to cut rates dramatically, 0.75%, because the global economy was starting to flirt with global recession. So again, why they raise rates? Well, because they have to do that to try to get the inflation rates down. And these are the different components that go into calculating inflation, from gas and energy to food, housing, car prices, et cetera. But just pay attention to the top numbers, the numbers in blue. You can see that over the year and a half, they were starting to rise to a peak of 9.1% in June of 2022. Luckily, since then, the rate of inflation has declined. But I want to point out, when they say the rate of inflation is coming down, it doesn't necessarily mean prices are coming down. It just means the prices are not going up as high, as quickly. So now they're going up 4% per year, year over year, instead of 8-9% per year. Justin Christoffel and Michael Fredericks, this is a kind of an important quote, and I'll sum it up. They're just simply saying, don't forget that when the Fed is raising interest rates, it can take 9, 12 months or longer to actually feel the effects within the economy. So the Fed just started a little over a year ago. And again, coming from zero, we really haven't been in a time frame where we're feeling all of those rate hikes. And especially, it's only been a few months where they've really begun to raise, going from 2, 3, 4 to 5% now. So we have a ways to go before the economy actually feels the effects. So this is a pretty good chart of the rate of interest. It shows you that interest rates are going to bounce around. They don't always move together in tandem. The blue dotted lines, that's the Fed funds rate. The yellow gold line, that is the 10-year treasury. And you can see going back to, if you remember back in the early 80s, 10-year treasuries were over 15, 16%. People had mortgages at 18%. I mean, just insane. But for 40 years, it's been declining. Rates have been coming down, which has been a real tailwind for the economy and the stock market. Well, now we're in a situation where rates are bouncing higher. And you'll notice here, and I'll touch on it a little bit later, but the dotted blue lines, the Fed funds rate, that's a real short-term overnight lending rate, that actually is now higher than the 10-year treasury. It's not supposed to work that way, and we'll cover why. So is there a reason why the Fed would stop raising interest rates? I mean, here's a good one. Here's a real big one. 3 banks just collapsed in March. Silicon Valley Bank, Signature Bank, what was it? First Republic Bank. These are big banks. They catered more to the institutional side, the hedge funds, the private equity folks. It's not so much mom and pop. So it was a big deal, but not many people on just Main Street really thought too much of it. But keep in mind, these 3 bank failures are 3 of the top 4 major bank failures in all of U.S. history. 3 of the 4 biggest bank failures in U.S. history. That's crazy and just occurred. So if that's something that's going to continue, then we really have to be on the lookout for that. Because why did it happen? A big reason is, as interest rates are going up, bond prices are dropping. They go inversely to each other. So interest rates have been coming up, bond prices have been dropping this past year and a half, and all these banks hold treasury bonds. A lot of them are underwater, and those banks collapsed. So you hear in the media, a lot of economists battling back and forth, talking about whether it's going to be a soft landing or is it going to be a hard landing. What does that mean? Well, in a soft landing scenario, the hope is it's kind of like Goldilocks. The interest rates are going higher, but it's not too hot, it's not too cold. It's just enough to get inflation down, but not enough to hurt the economy and drive it into recession. So they're hoping that inflation kind of starts to dwindle down. The economy, yes, is going to slow down, but it will just be able to maintain. The Fed maybe can keep rates or even lower them a little bit, and eventually the economy will get used to it and then start to take off again. That's the kind of that Goldilocks scenario. The hard landing camp, those are the folks that are saying, no, the Fed is raising interest rates way too fast. It's going way too high. It's going to cause a collapse. The economy is going to crash, hard landing, recession. People are going to lose their jobs, won't be able to buy certain items. And so eventually inflation, that will handle bringing inflation down. But it's not a great thing. I mean, yeah, less inflation, but because nobody has jobs, nobody has the ability to spend money. And that's a bad scenario. And in that case, if that were to occur, you're going to see the Fed lower interest rates and pretty dramatically. If it gets bad enough, they're going to go straight back to zero again. They've already been there. They know it. And it's like Pavlov's dog. They're going to go straight back to it, in my opinion. So the economy, is it ready to land? Well, we've got a lot of conflicting messages here, and that's the theme you're going to see throughout the presentation. So unemployment right now is at 3.6% as of June. Now, historically, 4% has always been known as 4% unemployment has been known as full employment. So you always have to have some people that are, in between jobs. They leave a job, maybe they have a couple weeks before they start a new one. They're traveling cross country, whatever it is. But 3.6% unemployment is ridiculously great for the labor market. So it's strong. Wage growth, it's improving, growing faster. Although at the other hand, the new jobs, there's fewer new jobs being created. A lot of the jobs that are being filled right now are the ones that were lost during the pandemic. The other thing is there's not been a lot of changes in layoffs or people quitting. That's kind of stagnated. One thing that I'm hearing out there is potentially occurring is a lot of companies are holding on to employees. They got burned during the pandemic, couldn't find enough people to work. And now there's a wait and see. Is the economy going to take off again? Is the airplane going to take off? Well, cool. They're going to keep the employees they have. Or is the economy going to drop? Is it going to be a hard landing? If that were to occur, you're going to see a lot of layoffs happen very quickly to make up for it. Also, where are we at? Well, let's first look at the US and Global Manufacturing Index. This is the PMI, which is the Purchasing Managers Index. The first one here on the left is global PMI. You can see just the steep drop here during the pandemic, and then the huge increase when all the stimulus came through. And this is just simply, it's a survey that's done every single month. They go out and ask the purchasing managers at all the big companies, hey, what are you doing? What are you thinking? You know, are you building inventory? Are you out there spending money because your forecasts look good, your products are needed? And if they are in good modes and they're spending money, then great, you're going to see that steep curve. But in this case, it's been declining for the last couple of years, slowly but surely. Now, to note, this number comes in June at 48.8. What does that mean? Well, just bottom line, anything below 50 on this index is contracting. The global economy is contracting from a manufacturing standpoint. Same with the US. So the US had the big jump up, and then boom, just another steep decline there as well. The US PMI comes in at 46.3, so even a steeper drop. The good news, swinging back to the other side of things, the good news is the service sector is doing better. And even better news is the service sector is bigger than the manufacturing sector. The US economy is service-based. I'm sure you've heard that. So it has a bigger weighting. So the thing that we need to be doing well, if we had to choose one, the service sector, it is doing well. It was in contraction area here just this past year or so, and it's bumped up quite a bit. So this is the US service activity index, and we're at 54.4, again above that 50 level. At that level, it shows the service sector is expanding and increasing, so that's good. How about the global service sector? Well, same thing. It came out of a contraction level and shot up higher. It was doing very well. It's now at 52.7, and we don't know yet. It's still very early, but that little hook at the end over there, it may be a one-time little blip, or it's a quick little downturn before it turns back up again. Or maybe it's the beginning of a sustained downturn, and after that, you'll see the US follow it potentially. We'll have to be on the lookout. Stagflation is a word that has been thrown around quite a bit in the last year or so. And basically, it just means you have an economy that is starting to slow down, even going into recession, but at the same time, inflation is still increasing. And that's kind of worst case scenario. The economy and all the folks out there, we can get through a recession. Not fun, but we can get through it. We're used to it. It's a slowdown. You get rid of a lot of excess stuff. You get back down to bare minimum, get strong, healthy, and then build again. The economy comes roaring back up eventually. But it's really difficult to do that when you have an economy that's going down, people are losing their jobs, they don't have enough money to spend on regular stuff. And at the same time, every time they go to the store or their insurance pricing or gas or whatever it is, that's increasing in price. That's an unusual scenario. I remember the gas lines. I was young, but I remember the gas lines of the 1970s. And that was stagflation. The economy was suffering and dropping, but at the same time, prices were going higher. We cannot have that situation at all. And that's why the Fed has been so vigilant in raising interest rates this cycle. They're afraid of seeing that happen. So financial markets, how do we look there? The little white things down here, these are horns. The folks on the bottom, those are the bulls. Bulls are the folks who are optimistic. They believe the stock market and the economy is going to do well, and they're excited about it. The bears are the ones that are pessimistic. They think things are going to crash and they don't like what they see. Well, so far the bulls are chasing the bears away because we've had a stock market that has just been running strongly. The market, the S&P 500 and everything else, the NASDAQ and Dow and all that stuff, it bottomed this past year in October of 2022. So it was a big decline. The S&P was down 25%. The NASDAQ, the tech stocks, were down, a little over 35%. So a deeper drop there. But then since October, literally the stock market stopped, turned, and really has just been driving higher. One of the themes is everybody is trying to get back into stocks because they really believe that the Federal Reserve is going to stop raising interest rates. They're going to turn and then start to lower interest rates. And eventually, yes, they will do that. But so far, this is in the face of steadily increasing interest rates. The theme goes back 10 months ago that the Fed was going to stop raising interest rates, but all they've done is increase them. So, there's a little mismatch there. One of the reasons why they're very excited, why the stock market is driving higher is, I'm sure you've heard of it, AI, artificial intelligence. That's the big word out there. It's just kind of like the .com was the big theme back in the late 90s, early 2000s. It's a story. It's something to grab onto, and it gets people excited. And, everywhere I turn, I hear AI. In this little cartoon here, the guy says, "Oh no, my robo dog ate my AI written essay." Well, they say when too many people know about one thing, and there's too many people on one side of the boat, it's maybe not a good thing. But I can tell you right now, at least, this is real. It is AI, artificial intelligence is transformative. We have been using some kind of a version of this for years now. And it's been just the last couple of years that this stuff is it's kind of like coming out of nowhere. And it's amazing. Productivity just shoots to the roof. The things that we can do now, from our tax planning software to financial planning, estate planning, it really is, I'm not going to say magical, but it's different. It is really different right now in a very, very good way. So people take notice, investors take notice. And you see here, the black line, the gray line, this is information technology. Here, the black or dark, whatever that is, light gray is communication services. These are the different sectors in the S&P 500. And so you can see that the technology components up 42% year to date, even a little bit higher now because July was good as well. But let's just go with these numbers: 42% in 6 months, 35.5% in this 6 months for communication services. That's huge. I mean, those are multi-year returns in just 6 months. So it's getting a little frothy. Everybody's getting excited, and rightfully so. There's a reason this technology is going to matter, but we want to make sure that we're not throwing money into things that have already shot to the moon. It's one thing to have a really, really good company or a really good technology. It's another, is that going to make it a really good investment though? Because if everybody's already piled in, the stock is already up 1,000% in a very short period of time. Is it ahead of itself? That's its own thing. You need to realize a good example in the year 2000, the tech wreck, the .com bubble, Microsoft, their stock hit all-time highs in the beginning of 2000, along with all the other tech stocks. Then they all dropped like a rock. The NASDAQ dropped 83% in just a year's time. Microsoft stock never got back to its 2000 high until the year 2016. 16 years of losses. So let's just keep that in mind. That's Microsoft. They exist everywhere. Everybody touches Microsoft in some capacity or another. So just remember that. It's important. First quarter earnings have declined. We've been waiting for this for quite some time. It wasn't as bad as considered, though. And so that's what's interesting is you see 78%. Let me get a little spotlight here. I'll do an arrow. How about that? Boom. 78% of S&P 500 companies reported better than expected earnings per share for the first quarter. Now, normally when I was younger, I would read that and think, oh, so they made more money than last quarter. That's not what it always means. So just kind of grain of salt, or at least some awareness. The media loves to do this. The journalists come out and they just say something. So better than expected in this case means the companies haven't lost as much as everyone did expect them to. So it doesn't mean they're growing. So on one hand, this is something to consider. I'm not saying that this is, danger, but everything needs to be a component. All information goes in. It's all considered here. So on one hand, we have earnings declining. They declined this past quarter, and they're on their way this quarter as well. But at the same time, we have stock prices that have jumped over 20%. That's a mismatch. So we don't know how it's going to play out, but just something to keep in mind. Profit margins are still strong, so that's a good sign. All right. Let's see here. All right. So Jerome Powell, Jay Powell, this is the head of the Federal Reserve. You may have heard his name, you may have seen him on TV, one of the most powerful people in the world, the person that is the head of the Fed. They control interest rates, quantitative easing, this QE that you've heard about, the printing of money. He and all of his folks behind him, they control all of that. And you can talk about people in political power here and across the world, all over the globe. It's the folks who control the money. They're the most powerful. And Jay Powell is one of the most powerful people out there right now. And so we listen when he talks. We're listening because we want to know what he has to say, but we also want to get an idea of what he's thinking. Sometimes they'll say certain things, and then it's not really letting the cat out of the bag, or they're trying to just throw a little trial balloon to see what the markets are looking to do. But everything's keying off of what Jay Powell and his group are saying. Some of the folks in the past, Alan Greenspan, Ben Bernanke, Janet Yellen, they've all been the heads in the past, and now Jay is leading the charge here. Greg Jensen over at Bridgewater, what he's saying here is the Fed does seem to be a little more realistic. They're increasing interest rates because of inflation. The markets, though, are jumping in anticipation that the Fed is going to lower interest rates. And we're finding ourselves in a situation where, from a valuation standpoint, someone's going to be wrong. Either the Fed, they're going to lower interest rates here pretty soon. And if they don't, well, now the markets kind of stretch beyond where they should be right now, at least, because everybody's buying in at that hope that the interest rates are going to drop. So if they don't, it's like Wile E. Coyote finds himself kind of over the cliff with nothing below him. So might have some volatility coming. Well, how about this? This could be a scary chart, but let me kind of explain a little better. So the money supply is contracting, and the money supply is like oxygen to the economy and to the markets. So money supply, first component is M1, that's cash and coins and just money that can be spent right now. M2 is M1 plus savings accounts and money markets, CDs. You always want to see money supply in general increasing. Again, that's the lifeblood of the economy. Well, where are we at right now? This is interesting to see. The money market has now contracted. So money supply, sorry, I said money market. Money supply has contracted by 2% now, year over year. Now, that's important because it's only happened 4 other times. Here, 1870s depression. Here, 1893 panic, where I had unemployment 18%. Here in the 1921 depression, a little baby depression before the roaring 20s came up, culminating in the Great Depression. So we are now here, the 5th time in all of history where money supply is contracting by over 2%. And each of the other 4 times have resulted in depression. We don't know what that's going to bring today, but I will tell you one offsetting factor maybe is the massive amount of money supply growth that occurred over the last couple of years. Remember, the Fed was printing money. We had all these PPP loans going to the businesses out there, extended unemployment benefits. So there's just been a ton of money flowing out there. As a matter of fact, the number that goes around is about 40% of all money supply in U.S. history was printed, was brought into existence by the Federal Reserve in about 2 months in 2020 due to the pandemic. The economy was shut down and it was looking terrible. And all they did, print. That's all they did. So this is a massive jump in the money supply. So this downturn, maybe it's not going to be as significant as it would be historically, but we'll see. It's something to keep an eye on for sure. So the good news, though, is consumers continue to be strong. They're out there spending. That's what Americans do. They get some money and they spent it. So again, the excess savings, like I mentioned, the money that's being printed out there, the unemployment benefits, the PPP loans, all the stimulus checks, Americans had $2.1 trillion of excess savings at one point. They've spent $1.6 trillion of it. So that's what's been keeping the economy going strong, or at least keeping it afloat over the last couple of years of difficulties. But a lot of that has been spent. But good news, I mean, that's still $500 billion of excess money sitting out there that's ready to be used. And Americans, they spend. So how do they feel, though? See, that's important too, because it's one thing to have the resources, but if you don't feel confident and you're not going to spend it, then the money sits, and that doesn't do the economy any good. So University of Michigan does a consumer sentiment index each month. And what's interesting is you see in January of this year, the number came in at 63.9. People were feeling okay, and then we had the banking collapse in March. Those three big banks dropped, and we had a drop in the consumer sentiment index. But here we are in June, right back to where we were in January. So it's almost like, it didn't happen, or it's not that big of a deal. It's over with, so we're fine. Okay, maybe. How about investor sentiment? A lot of the same folks, what do you do? What are you doing? Are you investing? Do you feel good about the markets? Well, in January, 20.5% of them were bullish. 20.5% of all investors out there were excited and felt good about the market. Since then, the market has been going higher and higher and higher. Lo and behold, so is the number of bulls. As the market goes higher, people get excited and they get more bullish. The opposite, the inverse of this, people that were bearish in January of this year, 42%. And now that the market has been running away, only 27.5% are bearish now. So kind of a mismatch there. Those that were neutral, they've declined as well. So basically, more people have scurried over to the side of the boat that is all positive, optimistic, and thinking things are great. Well, let's look at the other side of the coin here. What happens when everybody gets more bullish and they're buying? Well, it's going to push stock prices or real estate or bonds or commodities, whatever it is. When there's excessive buying, it's going to push those prices higher. Well, when you're investing in anything, stocks, bonds, real estate, you have to base your investments on valuation. What's the true value? Not the price of a stock, let's say, but what's the value that you're buying into? So one way to determine, is it good? Is it low valued? Is it fair to mid? Is it overvalued? One way to gauge that is through PE ratio, price to earnings ratio. And that is simply the price divided by earnings per share and gives you a number. And so Robert Shiller is a very well-known economist. He has his own version of the PE ratio. He's extended it out over a 10-year time frame to kind of get, smooth out the numbers, to get ups and downs rather than just a snapshot of one little time in history, because things change quickly. So he wants to look at over a longer period. But the bottom line is, when we're measuring the S&P 500, the stock market, the index, the value of all earnings, historically, that PE ratio comes in at 17. So that basically means investors are willing to pay 17 times earnings on the S&P 500. Well, as of the end of June, that ratio is at 31. So what it's saying is investors are, historically speaking, are way overpaying for each dollar of earnings per share in the S&P 500 index. So two things, maybe three things have to occur. Either earnings have to skyrocket from here. They're going to have to almost double to get back into equilibrium, or stock prices have to drop pretty dramatically to get themselves back in, to get the prices into equilibrium relative to earnings. Or we may see, we've seen this in the past, a combination. We may see an economy where the market, the earnings per share is driving higher. Companies are doing well, they're selling product, people are buying, and earnings are increasing. And then at the same time, stock prices are decreasing. And no one's going to understand that. They're going, why is that happening? That's not supposed to happen. Well, it does happen when you have prices that are so far stretched above where they should be right now. But regardless, this is not going to be able to foretell an imminent crash, but it does, again, one more little straw to throw on the camel's back and give us an indication of, right now, at least, I can tell you, things are overvalued with regards to the S&P 500 and all the indexes, really. So last year, let's move over to the bond market. Last year was the worst bond market in U.S. history. Again, interest rates go up, bond prices drop, and we're coming from the lowest interest rates in history, and so there's a long way to move up just to get to normal. So these different interest rates are for different types of credit, so different levels of risk, put it that way. So the dotted blue lines, that's the 10-year Treasury. Treasuries are that they're safe as can be. They're not going to go bankrupt. So interest rates move. Yes, that affects the bond prices, but all these other bonds here, these other lines, these are this dark, whatever that is, dark, I don't know, brown, whatever that is. That's the interest rate on the AAA rated corporate bonds. So the highest rated corporate bonds out there, they're very solid. They're not going to go bankrupt, you wouldn't think, but still they're going to have to be a little bit higher interest rate given than for the treasury itself for the same time frame, because there is risk. Let's say there's no risk that the treasury is going to go bankrupt, but there's always a risk that a company can go bankrupt no matter how big or good it is. So here you see, as you climb the ladder, you got this little green line or whatever. These are triple B, so the lowest investment grade bonds. And then you see the gold line. These are junk bonds or high yield bonds. You would expect they have to pay a much higher rate to get interest from investors, because there's a much bigger risk they can go away. One thing I'll point out, yes, all interest rates across all spectrum, all maturities, all the different bonds out there, all interest rates jumped up, but it was a pretty orderly. There's no big spike. There's no, huge panic like this here. This is 2008, 2009, and this is what we're looking for. These are credit spreads. If you hear that term, that's just telling us people are getting fearful when you see these kinds of spikes. The Treasury, if you see this, Treasuries dipped in interest rates, dipped because people were buying Treasuries as a flight to safety and selling all these other ones, which jumped their prices up. The bond prices dropped. Prices dropped. Interest rates jumped up, to the roof there. So, this is something that we really, want to pay attention to. Here's something else we really want to pay attention to. The yield curve continues to remain inverted. All that means is normally you would think that short-term interest, short-term accounts, if you got a 6 month, 3 month, 6 month treasury or a CD, you pay a certain interest. That's what you would receive from the treasury or corporate bond or bank CD, whatever it is. If you go a little bit longer out, go 5 years, 6 years, 10 years, whatever it is, you'd expect to get higher interest rates. Well, because of the time frame. But in this case, this is showing you the difference between the 10-year and the 2-year treasury. And so right now, the 10-year treasury, call it about 4%. It's yielding about 4%, while the 2-year treasury is yielding about 4.8%. So a big mismatch. And just simply the institutional investors, usually what this means, they are going out and buying longer term bonds, 10-year, even 30-year bonds, because they are afraid that the economy is going to slow down. They're afraid there might be a recession coming, and they want to lock in those rates for a longer period of time. So even though 4% is less than the 2-year at 4.8, or even the 6-month treasury at 5.5%, they're getting a lot lower rate right now. They're convinced that 6-month treasury at 5.5% is going to turn into 2% or 1% here pretty soon, and they're going to be sitting pretty with their 4%. So that's what that may be indicating here. It does historically, at least. So this is an interesting chart. I won't belabor it too much, but the S&P 500 is up, let's call it almost 20% for the year. But what's interesting, kind of similar, unless things change, but very similar to the experience in the 2000 to 2002 .com bubble, where at one point, the only thing that was going up was Microsoft, Cisco, Intel, Qualcomm, all the big technology companies. Everything else within the index was sliding down within the NASDAQ or the S&P 500. And what this is showing you right now is large growth stocks have gone up about 32% for the year as of June again. So large growth stocks is 1/2 essentially of the S&P 500. So the S&P 500 is made up of large company growth stocks. The other half is large value. So essentially you can see that if it weren't for, you take out large growth stocks, and the S&P runs the risk of actually having negative returns this year, potentially. So the markets are being driven by a smaller sector or a smaller portion of the overall market. A better example, maybe the NASDAQ, the technology index. Right now, it's up about 30 something percent year to date, doing very, very well. But in that NASDAQ index, over half of the components, half of the stocks in that index are down, still down 50% or more in value. That's kind of frightening. So what it's telling you is there's a smaller and smaller group of very big, powerful companies. Right now, it's your Amazon, your Apple, your Microsoft, your Facebook, Meta, Google. They're all doing amazingly well, but they're kind of the only ones doing amazingly well. But they're so big and powerful, they're pulling the indexes higher. Without them, it doesn't look so great. So again, I'm not saying it's not saying that the crash is coming, but it's something to look at, because if it continues, then we have kind of a bubble in just certain areas. What would be healthy is if all the other companies started to rotate in, and then they get a bid, they start to move higher. Then it would be a little more healthy, a rotation of all the different companies, and that might kind of quell some of the worry here. So what may lay ahead? Well, technology, there's no doubt. I mean, sometimes it gets overpriced, but there's no doubt that the technology itself is going to make just a dramatic difference in all of our lives. Immortality for sale. I mean, you're talking about technology that's going to allow the blind to see. It's going to, maybe they're talking about regenerating body parts. Being able to live not just longer. We're all living longer. My grandma's 101 years old now, and talked to her, and she's still doing well. But what's interesting, we're all living longer, but now we're going to have technology that will help us live better, longer, and healthier. Digital olfaction, here's a good example. Basically, your refrigerator is going to tell you, throw the chicken out. I need that, because I hate throwing food out, and I'll be trying to eat chicken for way too long. I can't get myself to throw it out. But the refrigerator will tell me, time's up, don't do it. Super app domination. It'll be a combination of a lot of different resources and technology all in one. Just go to one spot and do all your business, your banking, your investing, your Facebook, social media stuff. It'll be nice. Virtual power plants. Well, we're already kind of doing that. Folks that have the solar power panels, well, they're getting electricity at very low rates. I mean, they're paying virtually nothing for it now. And then excess electricity, they can sell back to Edison, back to the power plant. And that is then used for other folks. So it's kind of that, what is it? Well, it's compounding all the wealth and the benefits that are available out there, and just magnifying it. All right, so global growth, it kind of dropped in 2023, projected here. They are projecting that next year it's going to kind of bounce up a little bit. Nothing dramatic, but enough to keep things happy and cruising along. The US, however, is going to decline, is what they're projecting. And that's okay, as long as we don't go crashing through the floor there. But Euro area, same kind of thing. But you'll notice, kind of healthy, that rotation I talked about with regards to stocks. We also get rotation with regards to countries, different regions of the world, where they're going to be picking up the slack and provide strength and stability. So you get Africa, you get Middle East, Central Asia, other Asian countries. They're going to be increasing growth, which will help offset the decline in the developing world. It's kind of good. Well, here's one thing that worries the heck out of me. I know a lot of people say, it's no big deal. It is a big deal. I don't care what anybody says. We're living above our means. So right now, this is an old number. We got about $32 trillion of debt here, just at the federal level. Every other level has it as well, from the state to county, city, every company, individual. Debt is what has been continuing to expand year after year. It's what's driving the economy. There's good debt, there's bad debt. Good debt, you go buy a house, you put money down, you pay the mortgage over years and years and years, you stay there, you develop equity, eventually it pays off, and the house is worth much more than what you bought it at. That's the use of good debt. But this kind of debt here, where it's, we're not using it for productive means, it's like going out to dinner at an expensive restaurant every single night. You're blowing a bunch of money, and credit card bills are increasing. You never pay it down, it just keeps growing. Years later, you have nothing to show for it. You didn't invest that money. You didn't take that and go into debt to invest, to build a business or build better infrastructure. You just burned it. That's kind of that's the scenario that we're at. A lot of the debts, it's necessary. I get it, but we also spend money on things that I just saw something the other day saying that a line item in the U.S. government budget, trash cans. I'm assuming dumpster style trash cans were something like $50,000 each. That just means there's so much money flowing around, no one's really paying attention to what the actual cost is. That's got to stop. So this number here, this 24, that's supposed to be 24 trillion. Call it 25 trillion now. So a lot of these folks on Wall Street or in Washington, D.C., they love to spin things and say, well, you know, it's not as bad as you think, because out of the 32 trillion, we owe only 25 trillion to investors, you know, the public, you and me, pensions, other countries, et cetera. But 7 trillion, it's no big deal. We owe to ourselves. We just borrowed money from the Social Security and the disability trust funds. So it's not that big of a deal. And I'm like, I don't understand what you're saying. This still adds up to $32 trillion, no matter what you look, no matter how you look at it. Yeah, we have $32 trillion. It's got to be paid back. So it's not good. Federal government debt to GDP ratio, that just continues to climb. That just means how much debt do we have versus how much our GDP is each year. And bottom line is the debt is outpacing GDP. So that's what I was talking about. We're spending above our means and it's not being used for productive purposes. If we're spending this amount of debt or earning this amount of debt, but GDP is increasing beyond that, okay, then we used it for good purposes. But in this case, it's not happening. We're spending money, we're not being productive with it. How about interest costs now? Well, we just simply had interest rates go up, for the first time in years this past year. And our interest payment on our debt is now $1 trillion per year. That's just right now. If interest rates continue to climb, wow, that's going to be real bad, because I guarantee you the debt's not going to stop. They're not going to say, hey, whoa, we need to slow down. They're going to keep driving ahead. Debt will keep going higher. And if interest rates even stay where they're at, this is going to keep driving higher. Well, the offset is, well, for now, the government tax receipts have jumped as well. So that's good. But I also know that during recession times, like right here in 2000, 2001, and right here, 2008, 2009, tax receipts roll over and drop, and they can drop pretty dramatically. So, let's just say, what if tax receipts drop during a recession, and then maybe don't keep dropping, but maybe they just kind of go sideways for a while. Maybe they don't go racing back to all-time highs. Well, I know for a fact that this is going to stay high because we're only going to be adding more debt. And if we have a recession, debt's going to jump even faster. They're going to have to jumpstart things. So debt will jump faster and stronger. And then interest rates eventually are going to have to come up to reasonable levels. And we're going to be talking about massive amounts of money going out just to pay interest every single year. Scary. What do the experts think? Liz Ann Sonders, she is fantastic. She's over at Charles Schwab, and she's been talking about a rolling recession. And that's kind of what we talked about here today, that the good news is, yeah, there's been a lot of companies within the economy and different economies, different countries that are kind of going in and out. Some are down and others are up, providing stability. And then when things roll over, maybe, a different country, the Eurozone, they begin to strengthen and come back up a little bit, just as China is dropping down. So it's kind of a wave of things, a rolling recession. Not everything is cracking all at once. Let's kind of let the air out of the bubble a little bit. That's kind of good. Mike Wilson over at Morgan Stanley, he's been known as a bear. He has been saying, hey, the stock market's going to drop dramatically. And he was right all last year. And then it turned on him real quickly. And he just came out recently and said, all right, mea culpa. I was wrong so far, but I do believe that the market is going to come down and hit much lower levels. And then eventually, yes, it's going to get its footing. And a year and a half from now, the market will begin to really, build up again. But we have a valley to go through between here and there, is what he's saying. Mark Zandi over at Moody, chief economist, he's saying, what recession? All I see are good things. And the top three here, he's saying excess savings. So Americans have a ton of money from all the lending that was going on, or the stimulus checks and everything else. There's been a bunch of money that's still out there, that $500 billion. Labor hoarding, he's saying that as well. And that's basically, companies are not firing people right now. They're holding on to them. And if things muddle through and get back to going well, again, then this will be one of the few times we've been able to avoid having to see big layoffs. Will be kind of amazing. Low leverage. That is true. A lot of folks, a lot of you all refinanced your mortgage a couple of years ago, 2.5, 2.7%, 30-year mortgages. Never happened in history. It's not supposed to go that low, I don't think, but it did. So that's new this time. There's a lot of people that may have a lot of debt, but it's at very low interest rates. And so they're able to get through on some of these things here. All right. So we went through a lot of stuff, I know, and we're not going to have time for the questions, unfortunately, but we are always available. We want to hear from you. If you have concerns, if you have questions, it doesn't matter how small you think it is. There are no dumb questions, no silly questions. If you want to know the answer, then we want to hear from you. We want to know. So if we haven't talked to you in a while, whatever it is, you reach out, and let us know what's going on. But we're always going to be, out there kind of trying to touch base and staying on top of these things. But you can reach us, call us, email, through all the different social media platforms. We are available. And I will say right now, one of the things that we're really starting to head up here is year-end tax planning. Again, I talked about the AI, artificial intelligence. So we're using the tax planning software. So if we have not talked to you about this, reach out, or we will be touching you pretty soon here. What we're doing is taking the tax returns, putting it into the software program and letting it do its work for you. Are there any deductions that you missed by accident, you or the accountant? How about things like Roth conversion? Is there an opportunity to do that? Are there other maybe tax loss harvesting? What are the ways that we can maneuver and make adjustments that will keep money in your pocket? When you do the tax return, that's looking backward. That's getting the information from last year, putting it into the system, and how much do you owe or how much do you get back? That's one thing. Tax planning is all about looking forward. How can we keep you from having to pay more tax than is necessary next year, year after, et cetera? So that's a big thing that we're doing right now. So let's talk about that. And so that's it right now. I know it took a little bit longer than anticipated. I apologize, but I hope everybody got something out of that. And certainly we're here. So if you need us, if you have questions, whatever it is, just give us a call. We'll talk soon. Bye-bye.